In this video, what we're going to be discussing is the most coveted piece of your presentation with your client, the illustration. Now, in this video, we call this Illustrations Explained, because what we're going to be doing is help you gain a better understanding of exactly how an illustration works. Many of the agents that I work with have trouble focusing on the benefits for that client. So instead of using that illustration solely for the purpose of showing what the price is for the policy, what we're going to do is we're actually going to show that client the benefits to them personally. Also, what we want to do is we want to focus on the non-guaranteed side. So what we're going to do in this video is talk about the guaranteed column and how that is different than the non-guaranteed side, and exactly how you can push your client to focus more on that non-guaranteed column. Also, what we want to do, and the most important piece, is that what we want to do is we want to paint the retirement picture. What's in it for me? It's that principle. How are we going to explain to that client, the person that's paying the premium, exactly how this illustration is beneficial to them? Now, a lot of the times I'm asked, well, when should I use this? Or when should I talk about that illustration? Well, the fact is, you need to talk about the illustration anytime you're putting in front of your client some type of life insurance policy. You want to show them the benefits of that policy. So this should always be done after the type of policy and the life coverage amount is already determined. What we're going to use this for also is to validate the importance of a permanent policy. Having an illustration helps that client understand the value of what they're actually purchasing. So what's going to happen is they're going to focus on the benefit as opposed to the price. And also, when you do a re-proposal, anytime that you sign up your client for life insurance and maybe 6 months, a year down the road, you do another re-proposal, this is a way to help gain more premium because a lot of life events have changed. So in this illustration, this is a generic illustration from XYZ company, but there's certain hypothetical assumptions that we've made already. This is a whole life policy that we're showing for John Smith. John Smith's a 35-year-old male, doesn't smoke, so we're doing a non-tobacco rating. It's for $500,000 in coverage. Obviously, that coverage amount would be different depending upon who your client is. And also what we want to do, again, painting that picture for the client who's purchasing the premium, we're going to show withdrawals from age 70 to age 100. And this money will help supplement retirement, but we'll explain that a little bit further. So this right here is our generic illustration. As you can see, I already took the name off of this company, but many illustrations, depending upon what company you work with, looks very similar to this. So this is going to be a guide that you can use to help read the illustration that you're presenting to your client. Now on this, what it's doing is this page is showing you and your client exactly what the premium would be for the policy. So for this $500,000 in coverage, the total annual contract premium would be $6,240. Now, your client could pay that annually, semi-annually, quarterly, or monthly, and that's really dependent upon the company you're working with. Certain companies just do monthly and annually. Other ones have these 4 options. Now, there's plenty of information throughout that illustration. A lot of it are pieces that you really won't explain to your client. You'll let them read it on their own, and it's not something you should really have as a part of the conversation. But what this is really showing you on this page, it's a brief description of the policy, but one thing that you do want to focus on is the dividend amount. Customers always want to know exactly, well, how much of a dividend or interest rate am I going to be receiving on this policy? Well, in this case, the interest rate is 5.1% that we're going to be showing here. There's also a piece that we'll be discussing about taxes and how the taxation of a life insurance policy works. But the gist of it is, if the money is withdrawn properly, this can all be a tax-free amount that is withdrawn. This page is talking about the exact amount of premium that your customer would pay and the amount of cash value that would be built up based upon the guaranteed amount, the midpoint, we'll explain the midpoint in a second, as well as the illustrated value. Now, as you can see right here, the illustrated value is different than the midpoint, which is also different than the guaranteed value. Well, the way that it works is the illustrated value is exactly what XYZ company is paying today, and we'll show that same dollar amount going forward. The midpoint is basically cutting whatever that dividend or interest rate is in half. And the guaranteed is showing the least amount of money that that XYZ company is going to be paying out. Again, a bunch of information just about exactly how it works, year age, guaranteed columns, goes over all that, the annual dividend, just more definitions throughout that illustration. But again, not something that you go too much over with your client. Now, what we did here is we zoomed in on the illustration. So this is the exact illustration that we're going to talk about. Again, depending upon the company, it would be a little bit different, but this is a generic version of what it would look like. But the big point that you want to focus on here is that there are two different columns. This one is showing you a guaranteed dollar amount. This one right here is showing you the non-guaranteed amount. So what we want to do at this point is we want to focus on the non-guaranteed portion of the illustration. But the client always has trouble focusing on the non-guaranteed when there's guaranteed columns to the left of that. So what we want to do is we want to help our client focus more on the non-guaranteed side, steer them more to the non-guaranteed. So we need to explain exactly how both columns work. Now, a lot of agents I talk to, when they explain it, they say, well, the non-guaranteed side is what we're currently paying, and the guaranteed side is worst case scenario. Well, that's all they say. What we want to do is we want to elaborate on exactly what is worst case scenario. So any guaranteed column that you see on an illustration is saying right from the beginning, right when that client signs on the dotted line, company XYZ is not paying a dividend anymore for the rest of this client's life, but also the fees that are charged on the life insurance policy are at the highest possible level that the company can charge. So two things need to happen for the guaranteed column to come true. One, dividend not being paid for anymore, and the fees are charged at the highest possible level. And that needs to happen every single year for the rest of the client's life. But the fact is, the non-guaranteed side is showing what we're currently paying out in a dividend and the current fees that are being charged on the policy. So with that being said, which one seems more likely? Something that is automatically going to change based upon when your client signs on the dotted line and reduce the dividend to zero and charge the highest possible level of fees, or something that's already being focused on today, the dividend that's being paid out, as well as whatever fee that is being assessed on the policy. This helps the client understand exactly the benefit of focusing on the non-guaranteed side, since this is more likely to happen as opposed to the non-guaranteed side. So we want to explain that to the client. Now, it's really dependent upon the client that you're talking to as well. More of the engineer type, you'd really need to go into it a little bit deeper on exactly the fees that are being charged. But for your average typical client, just that explanation would help them focus on the non-guaranteed side. So what we want to do here is we want to show the customer that that's the annual contract premium that they're going to pay every single year for the rest of their life in this whole life policy. What's going to happen is that death benefit would grow, in this case, from $500,000 and would keep going down, keep going up. That by year 10, you have $542,000. By year 15, close to $600,000. So almost $100,000 of a death benefit has grown. And where does that $97,000 come from? It actually comes from the paid up additions that are being added to this policy. In another video, we talked about the different types of dividend options that are available. In this illustration, we're showing a paid up addition option. So more sticky notes, if you've seen that video, are being added to that policy. So we want to focus on the death benefit rising, but the other piece that we want to focus on too is, well, let's talk about that cash value. That net cash value that's right there in the non-guaranteed column. The net cash value goes from zero, right? And by year 10, we're already at $55,000. By year 15, we're at $110,000 of cash value. That money can be taken out at any time. Obviously, if you're taking it out, it would reduce the death benefit, but the money's available to your client. If we go further down, this is from year 17 to year 35. So this is from age 52 to age 70. The total amount of money that's being paid in by age 70 is $218,000. But the amount of cash value that's been built up into this policy is $510,000. So you put in 218, but you have 518. So you've already doubled your money in cash value. Now, if you wanted to walk away from this policy, you'd walk away with the $510,000. If you do that, two things happen. First thing, your death benefit ceases to exist, but also the growth, the difference between the 510 and the 218 would be taxable to you as ordinary income. So what we want to do is we want to focus on the benefits to the client, letting them know, Mr. and Mrs. Client, you're paying X amount of dollars on an annual basis, but look how much money you have, say at age 70 or 65, depending on what age you want to show them at. So this one right here is saying from age 106 to 120, you still have the policy in force. You're not paying any premium in the policy. But what happens to your death benefit? Your death benefit keeps growing. Now, the likelihood of you living to be 106, probably slim to none. But just knowing that the policy is in force for the rest of your life is comforting, not only to you, the client, but also the client's family. That's what this policy is showing. So that's the basic illustration, and that's usually how far agents will go when it comes to talking about an illustration. But if you show withdrawals as we have asked for in this illustration, that's the picture that we want to paint for our client. What we really want to do is we want to show them the benefit of this policy to the person that's paying the premium on an annual basis. So in any illustration, regardless of company, if you go to the supplemental illustration, it'll show you not only the amount of money that they put in, but also the amount of money that they withdraw from the policy. So as you see on the left-hand side, it's saying that you're putting in $6,240, and your cash value, as you see right here, will continue to rise. Each and every year, continue to rise. You're still paying your premium up until age 70. The total amount of money that you put in from age 35 to age 70 has been $218,000. But what we've asked RGA is to actually show a withdrawal from age 71 to age 100. So if I go to the next page, it'll show the benefit to the person who's paying the premium. In this scenario, based on non-guaranteed values, if you put in $6,000 each and every year, at age 71, you can actually withdraw $17,000 each and every year from age 71 to age 100 and pull that money out tax-free. So over 3 times the amount of money that you're putting in, you're able to, about 2.5 times the amount of money that you're actually putting in to the policy is being pulled out. As you see, each and every year from age 71 going down to 85, money is being pulled out. From age 86 to age 100, money's still being pulled out of this policy. Now, one thing that I always like to show as well too is in a supplemental illustration, it'll show your client exactly how much money they put into the policy and exactly how much money they've pulled out of the policy. So what's happening in this is that you've put in $218,000, but now you're pulling out all this money each and every year. But how long does this policy still last? All the way to age 120. So this policy, even though $17,000 per year is being taken out of this policy from age 71 to age 100, the policy still will last until age 120. Now, one thing that you must talk to about your client is if they do start to pull money out, the death benefit will reduce, as you can see, from 605 and it keeps going down to 294 and so forth. That's because you're withdrawing roughly on, 2.5 times the amount of money that you're putting into the policy. So the supplemental illustration is not something that a lot of agents talk about because a lot of agents do not show withdrawals being taken out of a policy. But ask yourself, why are you not showing that to your client? What you want to do is you want to show exactly the value of this type of policy for your client base. And the way to do that is show how premium can be put in, but then withdrawals can be taken out. And then explain to them how it can be essentially tax-free. So that's exactly how you would explain an illustration with your client. Now, again, when should you use this? Anytime you're having a discussion with your client about an illustration. Don't use that illustration solely for the purpose of quoting exactly how much it'll cost. Show them the value of the policy to the person who's paying the premium. Also, you can validate the importance of a permanent policy by showing how valuable withdrawals can be from taking out of this life insurance policy. And also, if you're looking at a re-proposal, show them exactly how much money they're pulling out. Over time, the amount of money that they can actually pull out of the policy could be actually higher than the illustrative values, because non-guaranteed amounts are based on today's dollars. So if dividend rates increase, interest rates increase, that cash value could actually be higher than the initial illustration. The benefits, again, to you personally, I'm not even going to say that. So this is Illustrations Explained. Hopefully this can help you build a better relationship with your client by empowering them to make a better decision on the type of life insurance that's best for them, by showing them not only the amount of withdrawals that they can pull out, but also exactly how it can protect their family. Again, thank you very much.